been a difficult few weeks for all of us on a number of levels, and I suspect that for a number of people looking at their KiwiSaver balances and other portfolios throughout the month of March will have seen some figures that we haven't observed in a number of years. In particular, we've seen the equity markets around the world have dropped substantially. We've had large movements in the bond markets, and the natural question is, what does this mean for me and what's it meant for my portfolios? I think one of the first things to acknowledge is that most portfolios will have seen losses during the month of March. A typical balance fund may well be down 10, 12 or more percent in a particular month. And these moves, whilst large, are not necessarily unduly alarming when taken into the context of a longer time frame. We typically think about a balance fund investor as to looking out above 5 years or longer. And on average, over the last 5 years, balance funds have typically returned, even allowing for March, 6% per annum, which is about in line with what we would expect over that sort of time frame. It's a hard question to answer, but the chances are probably not. One of the things that we're familiar with in New Zealand is the housing market, and we know that house prices can move up and down over a period of time. When house prices tend to fall, what we often see is that people don't sell because they don't want to realise a loss. They'll wait until the house prices go up again, or potentially even maybe try and buy a house when things are a little bit cheaper than they have been. It's not dissimilar into portfolios and asset management. If you're saving for your long term through KiwiSaver, what this means is that the funds that you're buying now are a little bit cheaper than they were 2 weeks ago, 4 weeks ago. What you don't want to be doing necessarily in this environment is selling your assets into those losses. But if you're saving, then you can continue saving for the future. And one of the areas that's different in this crisis from the financial crisis of a decade or so ago is that the banks are in a very healthy position and they can provide the levels of support that we need to see in the economy at these times. There's another angle that we should be looking at for fixed income portfolios as well. We see that credit spreads are widening. That means that companies are having to pay more money to borrow money than they were previously. And that's good news. If we can be a patient investor, that means that we can lend money at higher rates. That means that our rates of return will be higher than they otherwise were. So again, for the patient investor, this market provides opportunities in the debt markets for us to lend money, get a higher rate of return, and improve the portfolio returns looking forward. In terms of our particular portfolios that we manage at Nikko Asset Management, we are holding a little bit more cash than we typically would in the equity portfolios, around 3 to 5% in our core fund, and we're going to hold that waiting for opportunities to invest in companies that are looking to capital raise and those that will come out of this crisis with good cash flows, strong balance sheets, and an ability to grow for their investors going forward. In the concentrated fund, we're holding even more cash levels. We're holding up to 25% of the fund in cash. And again, that's partly to do with downside protection, but it's also looking for opportunities where we can invest that money sensibly and effectively with an eye on the medium to longer term for our investors.